is Benjarriola, and this is my road to retirement. This is episode 6, and in this episode I'm taking it outdoors, walking outside, and this is supposed to be my March video that I'm now talking about in April, and my February video was released in March, and I'm missing a real February video. But one of these days I'll get to do maybe 2 in a month, and it's hard to do these videos not being a full-time YouTuber, and I still have a day job that I have to keep, and that is the priority, and these YouTube videos are like my second priority. But anyway, going straight to our topic, it's gonna be mainly about my current trading systems as of Q1 2026, and I'll give updates to this every quarter. And so I'll share what I currently have right now. Historically though, I've been sharing my trading systems on the Blossom social network. If you're not aware of Blossom, I suggest you join it, mainly for the community. You could learn a lot from other people there. You can see on the Blossom network where everyone shares their thoughts in this community, and there's a community of stock traders, stock investors, a lot of financial advisors there, and a lot of DIY retail traders and retail investors as well. And I've been posting about my trading systems on the network, where you could see in this post 7 months ago where I talked about my trading systems, and then another post another 7 months ago in the same month, and then 6 months ago, 5 months ago, and that's where I talk all about these trading systems, the algorithmic rules, how they're performing, how much they're earning. And I thought maybe it's a good time to give some updates on those trading systems. But instead of posting again on Blossom, I am sharing them here on YouTube, sharing my journey here, and let's see how they're going. Now, before we continue, the disclaimer: this information shared on this channel is for education and entertainment purposes only, and should not be considered as financial advice. I am not a licensed advisor, accountant, or investment professional. All views expressed here are based on my own personal opinions, experiences, and journey towards financial independence. Investing and trading involve risk, and you can lose money. Always do your own research and consult a qualified financial advisor before making any investment decision. I'm not responsible for any financial losses, damages, actions you take based on the information presented in my videos, posts, or comments. Past performance is not indicative of future results. All investments carry risk, and individual results may vary. Some links in my videos descriptions may be affiliated links, meaning I may earn a small commission at no additional cost to you if you choose to use them, and this helps support this channel. So let's go ahead and continue. So what are my current trading systems? So all of these have names, and this first one is basically doing a leap covered call, which is more of an option strategy. And you could see here I give my initial capital for this trading system was $4,500, and when I started it, I didn't add any additional funds to this as it's going. And I show the current gains of how many percent, which is 11%, which over 222 days. Now, this second trading system called Premier Growth, this is more of a swing to position trading system. It's purely algorithmic, meaning it's automated. It uses algorithmic rules. Started with a capital of 5,000. It's been running for 423 days. No additional funds added. It does use a margin account, so it takes loans on the account, on the brokerage. And currently it is up by 86%, and current gains is around $4,315, and this has been running for 423 days. And then the next one I have is ruler stocks, another swing to position trading system, been running for 340 days, 21% gain since it's been running, which is around $700. And then hot stocks, started with 3,500, been running for 340 days, no additional funds added, and current growth is at 44%, around 1,500 currently in gains. Then I have a blue chip plus contra ETFs. Blue chips because it invests mainly in blue chip companies, but when the market is going down, it switches its strategy to use contra ETFs, which are ETFs that make more money when the market is going down. So sometimes it's called inverse ETFs, or I've heard some people say reverse ETFs, but there's also a lot of people just call it contra ETFs. Now here in the contra ETFs and the blue chip stocks, invested 3.9 in it. Started May 14, so 339 days ago. Currently up 26%, around $1,000 in earnings. And then doing a DCA, or dollar cost averaging, just started with $700. Not so old like the others, 127 days ago. And this is where I continuously add funds. The funds are not fixed, but the minimum I add is $88.88 every month. There are some occasions where I add a lot more if ever I have more money. So you could see the gain here is around 19%, so $100 or so. And then a trading system that involves dividend stocks in the US, because I also have one for Canada. So I started with 309, 256 days ago. I don't add any additional funds. It does use margin, and I reinvest the dividends that is earned from here, up 22%. And then I have a similar one, but runs on different rules, but mainly for Canadian stocks. And the starting capital here was higher than my US one, 4,500, 243 days. I also reinvest the dividends, haven't added any additional funds. It's up 15%, which is around $643 in gains. And then a covered call ETF plus a wheel strategy. So this involves covered call ETFs, but at the same time I'm running a wheel strategy, which is an option trading strategy that combines doing covered calls myself and also a combination of cash secured puts. And it's called the wheel because you move back and forth between them, but I'm doing them on top of covered call ETFs, which, by the way, after doing this for 2 quarters, I've decided I'm gonna discontinue this strategy and I'll do it in some other way. But since I've been running it, I'm still reporting on it, and it still gave a positive, 10% gain, but this was negative for a very long time. It was hard getting out of it. It was just so lucky somehow in the month of April this year, this current month, it just got out of it. But I'm gonna modify this, refine it. If I'm gonna do covered call ETFs, I'm not gonna do a wheel strategy on top of it. And if I'm gonna do a wheel strategy, I'm not gonna do it on the covered call ETFs. That's what I've learned from that. And then protective puts. I started doing protective puts on my overall portfolio, where I put a protective put on the index funds as a protection if ever the market continues to go down, and my portfolio is protected by this. So I treat it more like insurance. So it's more like a cost. I spent more, I could lose it if the market continued to go up. But if it did go down, it decreases the losses that I have. Now, so far in the times where I used this, when I thought the market would continuously go down, eventually it went back up. So the cost in the protective put I basically lost. But that's how insurance works, you know. You pay that premium as protection, but if nothing happens, it's a cost of that protection. That's why the protective put is at a negative 49, and I lost $1,213, spending $2,500 on it. And 40 days ago is when I ran this. And then I've also doing bottom fish and rising industries. So bottom fishing is trying to find the bottom of a bearish run of the market, and buying stocks that were beaten down so bad that might have a sudden surge or sudden increase, sudden increase in price, and riding on that surge. So far, this is relatively new, only 24 days old, and I'm still at a loss, 4%, because I did it twice, and the first time I did it was wrong. I made a mistake. I came in too early. It was not exactly the bottom. And then the second time I came in, I'm winning back some of the losses, but it's still a loss. Still a loss by 4%, but it's still running. It could still go up. It could still go up in the next few days, and possibly that loss will go away. And then if you put this all together, my overall portfolio, basically the initial funds of this, of all the trading systems, not my portfolio necessarily, but the total of the trading systems that are currently running at 36,700, it's been running for 420 days, and I've been contributing at a minimum $88.88 into it in a month, and it mainly goes to the DCA strategy. The current gains are 24%. Overall gain in dollar amount is around 8,000. So before I talk about the details of this, as like all my other videos that I posted and shared on YouTube, I give a status of my portfolio. I'm getting out of breath because I'm hiking uphill in the trail around my community, and beautiful sunny day, nice trees, and I'm just hiking up. It's inclined, so I'm losing some of my breath. But going to the portfolio I was talking about, so I'll take a brief stop here. Let's talk about our portfolio. 401k account, still at that 50k, not yet at the 100 milestone, however closely approaching that. I still estimate that I'll reach that before the end of 2006. As for my stock brokerage account, currently at 25k, however that 50k is very near. Most likely I feel I could reach that in the next few months. While the stock brokerage account, on the annual dividends, that has changed, and I know it says 2,500 every year in terms of dividends. I've already reached the 5k mark. and that was just reinvesting some of the dividends from some of the properties, and that already reached an annual amount of 5,000. So combining the stock and the 401k, we're still at the 100k mark, but looking at the month over month and year over year values, that has changed. The numbers you see here was in my previous video. Currently the month over month is higher by 5.7%. The year over year is slightly lower, but still in the positive, 24.28%. Rental property income still at the 10k mark. I'm gonna estimate I'll reach that second bracket probably in 2 years or so, because that will mean I already bought my second property, which is still gonna take a while. This new one is just going on its first year. So if I'm gonna estimate visually where I am in the 401k account, it's around there, because it's around 85k. And then when it comes to the stock brokerage account, I said I'm near the 50 mark. That is very near. It just needs a few hundred. In fact, one of my posts on Blossom talks about that, where I say, hey, I'm on track to the 50k portfolio, where in Blossom they actually post the milestone that looks like this, and you can see it's labeled as a 250k portfolio, and I'm close to that already, to the 50k. Once I reach it, the Blossom portfolio will automatically post that. It will post the 50k milestone marker on the portfolio. But let's go ahead and continue. So if you're going to look at the average portfolio value year over year, and you'll notice in this graph, I started doing stock trading back in 2012. It's been a while, but it's also my learning period. I haven't been doing things in the ideal way, and a lot of these losses I'm simply charging to experience. You can see for most of the time I was in the negative. I only got into the positive in 2020, and I would even consider myself somewhat lucky during that period, because that was COVID period, and I simply put all of my eggs in one basket, which is not advisable to do, but I did it on Moderna. And you know, Moderna was one of the vaccines used by for the COVID virus, and Moderna stock value started to jump up higher, and I was somewhat lucky there. And I did say my portfolio is near 50k, but you can see in 2026 that marker is just like just below 35,000, because the bars are representing the average of the year. So currently what you're seeing there is the daily average of all days so far in 2026, and there's some high days, there's some low days. So even though I'm near the 50k mark, the bars represent the average, and the average is still near 34,000 or so, because it gives a better representation of how the year felt, instead of just putting the last day, because sometimes due to volatility, stock values could just be high on December 31, and then the majority it's really low, and the very next day it could go down. So that's why I was plotting it as average and not really the last day of the month. So if you're going to look at this and what I've been doing, I've added different, what I've been doing in these different time periods. So to align them up, in 2012 I first started just learning about, you know, stock trading, and uh, wow, I've been climbing, and you could see, I could now see a bunch of rooftops because I've been hiking upward. Just by the look of the roofs kind of gives you an idea. Yes, I am in California. Houses look very similar with the like the clay pot tiles as your roof, clay tiles. But anyway, going back, 2025 I was introduced in my MBA when I was taking my MBA that time, in corporate finance. And as they were talking about stocks, kind of gave me an idea, made me want to try it. And that was mainly an introduction. But from there, I was mainly listening to Jim Cramer on Mad Money, because he was my main source of information. He's very energetic, very enthusiastic, and could get your attention, especially if you don't really know much how to analyze stuff. I was just going off his recommendations. And then you'll notice 2013, 2014 is blank. I didn't do anything because I think I was just losing money, and I didn't have the time, and just because I was going to negative, I think I felt bad about losing money. So I said, maybe I don't want to do this. So in 2015, what did I do? I paid more attention to Kramer and I watched more Mad Money. I was still in the negative, although I would have a few occasional wins, and in my losses, you know, I would blame myself for just not getting the timing right. But you could see in 2026 to 2018 I was primarily doing day trading and swing trading, but still losing money. I was introduced to the software VectorVest, but there's also a learning curve using the software. I really love the software. It helped me a lot as well. They have lots of trainings, but if you just subscribe and don't do anything and don't even study it well and not even following its advice, of course you'll still lose money. But it was in 2019 to 2021 where I was just simply holding positions. You know, I wasn't really learning how to do things. I was just, you know, holding it longer. And as I hold positions longer, this is the period where I was holding on to Moderna, and that's why you see the big positive jump. And aside from that, in 2021, I've learned, I went through a training going through vertical spreads, you know, a bull put spread, a bear call spread, and those were good. It was profitable as well. What you don't see in this graph though, this is an average of the portfolio value, but this actually goes up and also goes down. So there's a period here where it was really high, and I also lost a lot, and the amount that I lost here was significant. You just don't see it. But yes, I did lose there, which is the reason why I stopped in 2022. So 2022, where you don't see anything, indicates I didn't do anything. But you could also see 2022 was somewhat profitable because I was still holding on to some stocks. I was just not doing anything, and I was holding on to both Moderna and Pfizer, obviously because of the COVID situation. And there was a time where I let go of Moderna and I started focusing on Pfizer, but unfortunately Pfizer wasn't always going up. There was a period where it was going down, and during the period it was going down, that's why you see 2033 is actually lower, because I was also holding on to Pfizer for long, and that's when I started losing some of it. But in 2023, that's when I started, you know, learning more, and instead of doing vertical spreads where I lost a lot of money there because I was doing it incorrectly, but I've seen covered calls are more safer to do. I concentrated more on that, and then also did contra ETFs whenever the market was going down. I started doing more of that as well. And then come 2024, I revisit vertical spreads. I started making money from it, but the moment I had a loss, I stopped it again, because of the fear I had from my loss in 2021. But you could see in 2024 is when I start to do algorithmic trading, and algorithmic trading is more of automated rules stock trading, where you rely on software to do this. And this is where I believe I started to be more consistently successful. Like starting 2020, I was successful, but part of it was luck, and part of it was, I wasn't consistently successful. But ever since I did algorithmic trading, I started to do it better and started to earn more, and I was just more relaxed, no longer stressed that much, and started earning more that way. Now, aside from that, in 2025, this is when I joined the Blossom network. If you don't know what that is, you could go to blossomsocial.com, join. If you look at the link in my description, most likely it will be an affiliate link where I could get a small commission with no difference to you. It's still free. Actually, the whole platform is free. There's the option to get a paid subscription for additional reporting benefits. However, you could still join free without paying anything and being a pro member. But ever since I joined Blossom Social, I learned more. I learned more about, other things that you could do, because the community is all sharing information. And there's also a lot of debating on the platform. People saying, my strategy is better than yours, or, you shouldn't do that, you should do this. But I just take everything with a grain of salt and just try to learn from everyone and just try to do all strategies all at the same time and test it. If it works for me, then I continue. If it doesn't work for me, I discontinue. But from there, I also started focusing on some dividend stocks and also focusing on some covered call ETFs and getting some distributions from there. I learned the wheel strategy, which is, I've already been doing a covered call for some time, but I wasn't doing a cash secured put. And after realizing that I could just do them back and forth, and that is the whole wheel strategy. And then I learned more about leap covered calls, and also the protective puts, and doing a DCA on an index fund. If ever there was anything I would change here historically, because you could see I had a long learning curve and I didn't have all the time to learn. I'm a full-time employee. I didn't have all the time to learn how to do all these stuff. And during that learning curve, I wish I should have learned more about dollar cost averaging early and just going into an index fund early. And 2012 up to now, that would have made a big difference to my portfolio. But I just wasn't aware of that. For some reason, I went straight to swing trading, and and that's how it went. Anyway, with all that said, do I regret all of this? Not really. I still learn from everything. Mistakes are still learning, basically. And just looking at how my portfolio performed compared to the S&P, you could see, over the past 7 days, I'm higher than the S&P, where you could see, over the past 7 days, I'm actually lower than the S&P 500. But over the past month, I'm still lower by 4.29%. Over the past 3 months though, I am higher than the S&P at 12.94, and over the past 6 months I am lower by 0.7, and over the past year I'm higher by 9.79%. So overall, in the long run, I still seem to be outpacing the S&P 500 year over year, and that's what is, you know, important to me, to tell me if swing trading and position trading is even still worth it. And as long as year over year I'm still outpacing the S&P, then that tells me it's still worth doing position trading, in my opinion. Now let's take a look at the live data from Snowball Analytics, because what you're seeing in these screenshots are also what I have several weeks ago, because I also don't have the time to do all this, to do the videos right away. So let's go ahead and open up Snowball, and I'm currently hiking, so I'll go ahead and try to share my screen while I'm recording this. Okay, so I'm now in my live Snowball Analytics, which I'm showing on my phone over here, and I'll do a screen recording at the same time. But you can see over the past 7 days I'm pacing lower than the S&P by 0.18%. Over the last month I'm outpacing the S&P by 0.95%. Over 3 months I'm higher than the S&P by 3.35. In 6 months, higher by 9.24. Year to date, higher by 17.72. 1 year, higher by 0.53. And then 5 years, you'll see I'm lower by 84.85%. Okay, some things you're already aware of and not aware of. If we go back to the deck, you'll see, you know, past 7 days, past month is doing everything that I've been mentioning. Past year is also everything that I've been doing. If we go to the past 5 years, that was even the time when I stopped doing anything. That was 2022 to 2021. Of course, I wasn't outpacing the S&P during that time, since I was still learning how to do all of these things. So that's where we are now. So going back to these trading systems, there are some that are light colored, some that are dark colored. So the ones that are light colored are basically the ones that are algorithmically happening. It's algorithmic trading. It's based on rules. It's based on a software that triggers the rules when the rules are met and the trades are made. And you can see everything in light colored are all in the positive. Now, everything that are in darker colors are manual. These are strategies that I've been trying to learn myself. And you can see some of them are in the green. They are profitable. You can see that there are 2 that are not profitable. And these require some learning, they require some effort. And some of them I wasn't doing properly. And because I wasn't doing properly, that is why, you know, it wasn't earning. But to go all of these, you know, it's a lot of time, and I decided let's just go through the algorithmic ones, since this video was primarily about the automated trading strategies. And in these automated trading strategies, we'll go ahead and work through them. So let's go ahead and go through these. Since I don't have the time for going through all of them, I'll go through the top earning one and the lowest earning one. And the top earning one is the Premier Growth, and the lowest earning one is the dividend stocks in Canada. So the top earning one, let's start with that. And how does this happen? Before I continue, I'm going to go downhill, but again, not through the street, but more through the trail. And I'll start going up this trail again. It goes up, it goes back down. So, algorithmic rules, you know, there's simply an algorithm. And in those algorithms, you have rules. You have rules for entry, you have rules for exit. And in these entry rules, it depends on market timing. And when we look at market timing, I am reliant on a software called VectorVest that has a lot of market timing indicators, but their market timing indicators are somewhat proprietary to them. But they do give some type of description to them where you could try to simulate them in your own brokerage just by definition, but in the software that I use, it's basically automatic. And when it comes to algorithmic trading, I've looked into other solutions in the past, from Quant Connect and also Lumibot. Those were the two that I've looked at. Both of them require some level of coding. However, I am a coder and I know Python, but I'm also lazy. And VectorVest was an easier path forward without going through those coding. And it was mainly form-based, that you just fill up forms and let the algorithm run. So, in the market timing, I was using the GLB timing indicator. And GLB just means green light buyer. But in this software, VectorVest, it gives you a green light when you get some of these indicators. And the main one to get a green light, which is defined as a green light, is if the overall average of all stocks in the stock market is higher day over day, week over week, and month over month. When that happens, you get a green light. Now, when you say all stocks, it's literally all stocks, but they exclude penny stocks. So the closest you could get to that probably is looking at the S&P 500, the Russell 2000, the Nasdaq, and the Dow Jones all together. And if they're all going up or if they're all going down, is an indicator of the whole stock market's going up or the whole stock market's going down. Or you could look at ETFs that track all stocks worldwide, all stocks altogether. And if those tend to go up in price, then most likely the whole market is also going up in price. So, green light buyer is the overall average of all stocks are increasing day over day, week over week, month over month, year over year. And then basically I have to buy 10 stocks during this period whenever this happens. Unless I already own 10 stocks, then I don't. But if it's less than 10, then you buy to continue to fill up the 10. And then invest in an average portfolio value. What does this mean? This means if every position you take among the 10 will have 1/10 of your portfolio value. So to quickly think of that, you could see my initial funds here was 5,000. So every stock I buy in the first time I ran this will be 5,000 divided by 10, which is 500. whatever the stock price was, let's say the stock price was 50 bucks, then I could only buy 10 of that. If the stock price was 100 bucks, I could only buy 5 of that, so that each stock will not go beyond 1/10 of the portfolio value, so that they have like equal bearing, because not all of them were perform well and some of them were perform bad, but at least there's no single stock that will bring the whole portfolio down if it does bad. Only 1/10 of it will go bad, basically. And then do not invest in sell rated stocks. So when we talk about sell rated stocks, again, I'm relying on the software VectorVest, where it just tells you it's sell or it's buy. But looking at their indicator of how this is doing, they calculate a stop price, and generally if you hit the stop price, it's time to sell it. And how they calculate it is based on a 13-day moving average of the stock price, and they say they adjust it to the fundamentals. And when they say adjust to the fundamentals, if it's a pretty good quality stock, then that 13-day moving average is moved lower, while if it's a low quality stock based on the fundamentals, that 13-day moving average is moved higher, so it exits out quicker if it's a lower quality stock. If it's high quality stock, it doesn't exit as quick as a low quality one, but it's still based off a 13-day moving average. And then this trading system uses a margin. I typically was not comfortable using margins in the beginning, because you know, you're paying some interest on that. You're like taking a loan on your brokerage, but as you're taking that loan, you could earn higher than that interest. So what made me decide to use the margin? You'll see in one of my previous videos where I run back tests, and when I have back test, and during the back testing, with all the trading system parameter rules are done and it's tested on historical data, and I did like 5 years, 10 years just running the algorithm, and I tried it with margin and without margin, and the margin max I was using was 50% of the portfolio value was the highest amount of margin I could take. And then I would enter in the interest rates of the brokerage within the software to calculate if I'm profitable or not. And so far, in this specific trading system, it is profitable. So that's the only time I became more confident in using margin, and I used it in this trading system. Now, when do I exit a trade? I exit a trade once the stock gets a sell recommendation. I talked about that. It's based on the stop price. The stop price is near the 13-day weighted moving average. And then, which I explained there. And so, if the market timing goes down, I don't necessarily sell all the stocks. I still keep them. I only sell the ones that got a sell recommendation. But if the next cycle where the market timing goes up again, then that means I fill in to the remaining 10 positions. If ever I sell a stock, but because it hit the stop price, but the market timing is still up and I need to fill in the 10 positions, I won't buy the same stock that was sold after a day. Maybe after 2 days I could buy it, but after a day I won't buy it still, because that stock might still be in a downward trend, no matter what the algorithm says. Now, how does it choose the stocks? So these are the stock scanning rules. You know, stock has a projected price to appreciate for the next 3 years that could outperform a AAA corporate bond. So you could Google rates of a AAA corporate bond, find what the rates are, and if this stock has a history of outperforming that for 3 years or so, then we consider that as a safe stock, and those are the stocks that will be included in this scanning rules. Since I'm using a software to do this, and they have a specific metric for this that they call relative safety and relative value. So relative value, if it's above 1, it most likely could perform a AAA corporate bond. And then if you don't have relative value, maybe some kind of substitute that you could use would be looking at, you know, EPS growth plus dividend yield plus valuation boost. And that valuation boost you could do as historical PE ratio divided by the current PE ratio raised to the 1/3, which is a cube root minus 1. Now, I can't specifically explain why that is the formula, but I relied on AI tools to find an equivalent for the RV of vector vests, and it did suggest these. However, we don't really know how it's computed by this proprietary metric used by this software. And then the stock has to be undervalued. Now, again, in the software that I'm using, Vector Vest, every stock has a value, and you could compare it with the current price. So you simply compare price and value, and if the price is lower than the value, then it is undervalued, and that is a nice stock to buy. But if you want to try look for an equivalent for that, doing some research, you could look at the PEG ratio, and if it's less than 1, then most likely it is undervalued. So that is primarily the Premier Growth. Now, the good thing about the Premier Growth, while I release this video right now, Vector Vest themselves talk about this trading system, because this is one of the built-in trading systems within the software. They have multiple trading systems, and you could simply pick and choose which one you want to use. And you could also edit the parameters, and what I was using here was simply default parameters. And I'll share a link to that video, and you could view it by looking at the link in the description. It is a great video to watch, and even though I keep talking about Vector Vest, I don't earn anything promoting it. They have no affiliate plan. I would truly appreciate it if they could give me something for it, but I don't get anything from it. So let's now go to the lowest earning trading plan that's automated, which is the dividend stocks in the Canada domiciled ETFs. So let's go ahead and take a look at that. So algorithmic rules, my entry point is basically the market timing signal is now called the covered call. Again, another proprietary system, but how is the covered call defined? It was similar to what I mentioned in the green light buyer, but there's an additional metric here. The buy rated stocks have to be more than the sell rated stocks. So, and I mentioned the buy rating, the sell rating, you know, it reaches the stop price. The buy rated though is more complicated than that. It looks at different metrics of if a stock is going in an upward trend, and if it also has, you know, some value and safety metrics also in the positive. And from there, that is where we look at the buy rated ones, and buy rated should be higher than the sell rated. So that is one of the criteria for the market timing. And very similarly, I also buy 10 positions. Again, invest them equally, like 1/10 of the portfolio value. Don't buy any sell rated stocks, and this also uses margin at 50%. Now my exit points here, basically it gets a sell recommendation. We talked about that definition from the 13-day moving average. And then again, replace any stock that has sold if ever it's still in a buy indicator within the market timing signal. And don't repurchase the stock within 31 days. Compared to the other one, it was within 1 day. This one, if you sold it, you can't buy it again unless 31 days pass by. Now, stock scanning rules. So to look at the rules, dividend yield, since this is a dividend trading system, it looks at stocks that also have some dividends basically, and it's higher than 1.2%. Dividend growth should be increasing at least by 6%. From the Vector VES proprietary metrics, it's a recommended buy. VST is greater than 1. VST is value, safety, and timing. So it's a combination of good value, it's relatively safe, and it's in an upward trend. Dividend safety is 40, another proprietary metric, but this is how safe the dividends are. Like, they consistently give dividends every time they're released, whether it's week over week, month over month, quarter over quarter, or annual. As long as it's consistent and they don't have any history of disappearing dividends or decreasing in value. CI, or comfort index. This metric talks about if it's above 1, the stock price doesn't go through long times of downward trends. It's very resistant to downward trends. If it does go in a downward trend, it doesn't stay there for long. And if CI is above 1, there's a tendency that the downtrends are truly permanent. I'm truly not permanent, I mean, they're temporary. And prices above 4, so that we just avoid the two cheap stocks, which are usually not that stable. And then for some reason in this trading system, mining stocks are avoided. I don't know why, but if I'm gonna guess, it's how volatile they are. And for these stocks, these are being held for longer periods so that you do meet the dividends, because there is an ex-dividend date where you're supposed to own them before you receive your dividends. And if there is a specific sector that kind of jumps around and will kick you out, then you won't earn the dividends. And then 30-day moving average is above 20,000 to provide some liquidity there. And then dividends in the past 110 weeks grew higher, and also as the overall 110 days. So this is just looking at the overall dividend value, where they have been increasing, and part of the scanning rules will be looking at those stocks where the dividends did increase. So we went through all the trading systems, not all. We went through an overview of all trading systems, and we described the highest earning automated one and the lowest earning automated one. And that's basically an update of my trading systems. I didn't go through all of them because that's a lot time consuming, but I basically rely on software to run these. And I'm currently a user of Vector VES to run them. My portfolio is positive, and it's outdoing the the S&P. So I'll continue to do it as long as it's outperforming the S&P 500. Then using that as the benchmark tells me that the swing and position trading is worth doing. And even if so many people say timing is difficult, and it is, but that's why I'm relying on software to do it for me with algorithmic rules than me doing it myself, because I'll totally get it wrong. So anyways, that's the update on my trading systems. I'll do this every quarter, and I'll tell you what trading systems I'll drop and which ones I'll keep. But one of them that I'll drop, I already mentioned, was doing the wheel strategy, the wheel option strategy on top of covered call ETFs. Totally not worth it, in my opinion. But I'll replace it with something else, and I'll give those updates later on. Thank you very much. Benj Arriola is out.